In the autumn of 1720, two of the most powerful financial empires in the world collapsed within months of each other. These collapses occurred in different countries and under different legal systems. The leaders had never met, and the investors spoke different languages. Yet both markets peaked and collapsed at almost exactly the same time, destroying roughly equal proportions of national wealth in a single 12-month window. This left an identical trauma in both France and Britain, a generation-long aversion to paper money, joint stock companies, and financial innovation. This was the first synchronized global financial crisis in history, two bubbles in two empires, popping in 1 year. The men who built these systems, John Law in France and the directors of the South Sea Company in Britain, were watching and copying each other. They were competing for the same capital in a world that was becoming increasingly interconnected. Law believed paper money issued against productive assets could replace metal currency to expand an economy. This is the intellectual foundation of the monetary policy practiced by the Federal Reserve and the European Central Bank today. Law implemented his theory in a world without the institutional frameworks to contain its failure. The resulting synchronization between France and Britain models how systemic market risk functions across borders. When Louis XIV died in 1715, the French state was functionally insolvent. After a 72-year reign of war, the national debt equaled 15 years of total tax revenue. Interest payments consumed most government income. Traditional fiscal reform was impossible. The debt was too large. France also faced a metallic constraint. Under a gold and silver standard, the money supply was limited by the accidents of mining, which throttled the velocity of trade and production. John Law, a Scottish mathematician and gambler, arrived in Paris with a solution. He had spent 2 decades studying European monetary systems and writing theoretical pamphlets on credit. Law argued that a nation's wealth is defined by the activity of its economy and the productivity of its people, not the amount of gold in its vaults. He proposed replacing the metallic money supply with paper notes issued against productive assets, such as trade revenues and colonial land development. This proposal established the logic used by modern central banks. Law understood that matching the money supply to the needs of the economy could stimulate growth that metal currency never could. Law's architecture began in 1716 with the Banque Générale. It was France's first real bank, issuing paper notes redeemable in silver that were accepted for tax payments. The notes circulated, credit expanded, and the economic activity Law had predicted began to appear in the French merchant class. In 1717, Law established the Mississippi Company. He secured a royal monopoly to develop the Louisiana Territory, a vast region most French citizens knew nothing about other than its enormous size. To manage the debt, Law let investors exchange government certificates for Mississippi Company shares. He then merged the company with the bank, creating the Banque Royale. He erased the boundaries between the state bank, the money supply, and the trading monopoly. This single macro entity effectively controlled the entire financial system of the most powerful kingdom in continental Europe. A feedback loop emerged. Law issued new shares at higher prices to retire more government debt, which increased confidence in the government, which in turn pushed share prices higher. The mechanism that accelerated this rise into a speculative bubble was the use of margin. Law encouraged investors to borrow the funds needed to purchase more shares. Investors borrowed paper money directly from the Banque Royale to buy shares, intending to use the rising price to repay the loan. To fund this, the bank printed more notes, expanding the money supply exponentially to artificially support the share price ticker as it hit 10,000. This creation of paper wealth resulted in localized asset inflation. Across the French economy, rising prices were initially perceived as systemic prosperity. In Paris, a new class of wealthy share traders emerged. This period of rapid asset growth gave rise to a new term in the French language, the millionaire. This system was unsustainable. It required the constant printing of currency to maintain margin loans against a single equity asset that had yet to produce significant trade revenue. Across the Channel, the British government watched the French boom with envy while struggling with its own fiscal challenges. Britain held a national debt of roughly £50 million, primarily left over from the War of the Spanish Succession, and was paying £3 million annually in interest. In 1720, the South Sea Company proposed converting £30 million of government liabilities into company shares, imitating Law's model. But Britain lacked the central banking engine France had built. There was no Banque Royale to print money and fund margin loans. To drive share prices, the directors relied on a promotional operation. They circulated optimistic trade projections for South America that bore no relationship to the actual commerce taking place there. The share price rose from £128 in January to over £1,000 by June, mimicking the Mississippi Company's trajectory. London was gripped by a mania. People from all classes of society traded in crowded coffeehouses, investing in various joint stock companies, ranging from legitimate trade to fraudulent undertakings. Britain had successfully reverse-engineered Law's bubble mechanics to liquidate debt, but the company lacked the productive revenue or monetary support to justify its valuation. By early 1720, Law's system in France began to fail. Investors lost confidence in the paper shares and attempted to convert their holdings back into silver. Law attempted to arrest the decline by reducing interest rates and attempting to control the share price. Finally, he suspended the convertibility of his paper notes into silver. Suspending convertibility caused the currency to hyperinflate. As investors fled paper, the Mississippi system disintegrated. The systems were connected by cross-border investor psychology. The same major capital was active in both markets. The collapse in Paris demonstrated to London investors that these state-sponsored debt systems could fail. This realization destroyed the confidence sustaining the South Sea price. London investors began urgent liquidations to cover losses in Paris and rebalance dangerously concentrated portfolios. Consequently, South Sea shares fell below £200 by September, sitting below £100 by year's end. The Banque Royale's notes became worthless, ending Law's paper money system, and leaving the French public with a deep distrust of financial innovation. Britain restricted the formation of new joint stock companies for a century, but they retained their core banking institutions. The British financial system preserved the utility of paper credit while moving past the mania. Law died in 1729, still convinced his ideas were sound. In many ways, his theories about how paper money can mobilize human effort were correct. His error was in the implementation. He was right about the potential of paper currency, but he failed to account for what happens to a system built on confidence when that confidence is exhausted. The events of 1720 function as a structural warning about synchronization. Today, global financial markets are more integrated than at any point since 1720. Synchronized monetary expansion and tightening create stress across multiple markets simultaneously. Global investment booms are now funded simultaneously across continents by capital markets that react to each other's signals in milliseconds. This interconnection creates an amplification effect. Mutually reinforcing systems make the ascent larger than any single market could achieve independently. But when these connected systems fall, they fall together. They fall faster and with cross-border consequences that no single participant can see coming.